Just make one up. And we are live on the launch, and we're taking your property investing to the next level. How you going, Tom, Tommy, Thomas, whatever? I don't know. I don't know. I'm just confused. What name they calling people in WA these days? How you going?
I'm good, mate. I'm good. How are you?
I love. Yeah, I'm very. My last day work, so well for the year that is. I'm not going rogue like Joe, not yet. Anyway, at least I'm not. I probably should. Yeah, no, really, like absolutely. Like I feel pumped to just like dedicate a couple of weeks to this. Yeah, feeling good anyway. That's my crux. How you going, Joe? What are you up to, man? Apart from losing,
mate, I'm fantastic. I'm deep diving into property data and going absolutely mental with the numbers. But I'm super excited for today's chat because this is economics. This is what sits over the top of all of property investing, and that's why we wanted to get on the Stig of economics, Mr. Tommy. So I'm pumped for this one, man.
I don't watch Top Gear. So why is he the Stig of economics? Like what?
Yeah, I don't know either. I don't know what the Stig is. So.
Oh well, the way they pump up, you don't know who the Stig is. Oh my god!
I mean, I know who the Stig is. The guy who does the helmet Top Gear, but like I've never really seen the show. So what is the reference to Tom Wars?
Well, it's because the way I, introduced him, they always said like, the tame racing driver. Some say that he's, killed the president, but others say that anyway. So that's how. Anyway,
cool. Okay.
It's all about the poster. It's all about the pump up. So he is a mystery. He's a man of mystery. That's what it's meant to be, kind of thing.
The North and mystery. Speaking of pump ups, I want to see comments. I want to see questions. I want to see because this is the last live session of the year. It's going to be big. It's going to be epic, and it's over in WA. It's only just gone sort of 4:30ish. So if we can, I was going to say we can go all night, and I don't have anything to do in the morning, so I'll go. I've got a stock fridge full of stuff. So if any broker question, but anyway, let's get to the quote of the week. So the guest is going to go first. So what is your astound us with your quote, Mr. Tom?
All right. My quote of the week is by Walt Disney, and it's the way to get started is to quit talking and begin doing. And the way I kind of looked at that was when I read it, I thought, this is actually pretty good because, and we're all obviously property investors here, and it's sometimes you get a lot of the talk, a lot of the maybe what if this happens, what if that happens, is this good, is this bad? But at the end of the day, action is better. Just get on with it, buy it, and then the results will come later. So otherwise, you're going to be in the same spot in 5 years' time where you were 5 years ago.
Yeah, pump it up as Joe and I have been talking about.
Yeah.
And what's the and so that, man, that's a fantastic quote because a lot of people worry about the economy. The sky's falling, Evergrande's all these kind of all these kind of trade wars. There's a lot of noise happening out there, and maybe we can dig into some of those if there's interest. I want to hear what the audience wants to hear about the economy. So if you've got, we can dive into some of these and that. So I'll give my quote because I think Joe's he's coining his quote now. He's got a Joe original probably, but my quote I've actually got it. I wrote it down. So what did I don't remember it off the top of my head. So I'm super prepared. But so this is a Mark Twain one though, and he said, whenever you find yourself on the side of the majority, it's time to pause and reflect. So I thought that was appropriate for the economic chat because a lot of people sort of worry about what's going on in the news, how many Weet-Bix Donald Trump is eating for breakfast, because that has a lot of bearing as to what the economy is going to happen. But yeah, I suppose that's kind of why I wanted to bring that quote to the table. So Joe, have you been able to quickly Google and find your quote for this week?
I have a great quote which I really enjoy. Knowledge is empowering, but only if you act on it. That is my quote. Very similar in your vein, Tommy, but it's very true. Like, we put out a whole heap of knowledge and information with this group, and as do you, Tommy, you're a big contributor to it. But if people aren't taking action, if you aren't taking those next steps to get it done, it's a bit silly just gaining all this knowledge and then not using it and taking action. So that's my little quote of the week.
Love it.
Nice.
Great.
Have you got?
That was it.
I'm waiting for Joe. This is where you lead, Joe. Maybe we should rehearse this prior to.
Definitely. Yeah, we definitely should. Okay, we're going to jump into our sponsor.
Then we're going to give a massive pump up to our friend Tom.
Absolutely. That's what we're going to do. So let's do it.
The stick of economics. I think that's going to stick.
The amazing commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia. And not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
Now, Steve's not going to like this, but it's okay. If he's not going to like this, I hope he's not watching. But if you put festive in there, you'll actually get it for, I believe, is it 80? I think he's giving it away for free plus postage.
He's doing free, yeah, free. Yeah.
Yes, exactly. That was one thing I was going to mention.
Is that in the background? I can see it.
Yes, it is. You've got the little book up there.
Bit of free advertising.
Yeah. Mate, that's everybody. Even the Stig. I'm going to stop calling you the Stig. Yeah. So I love that kind of commercial kind of vibe, and we've got a bit of a giveaway at the end of the session. So you have to tune in. I should have saved that code to the end. But the person of the hour, Mr. Tommy James, and so you've written an absolute cracker of a steal for me. So it's saying you enjoy helping property investors to smash out their kind of loans and their mortgages. You spent, I believe, 13 years. I always get nervous when I say this, in the military. So I was going to say Army, Navy. I was like, but military, I don't know which. I mean, because I think there's a bit of a divide there. But not a divide, but there's a difference, a large difference. So I want to honour that. And you still enjoy though camping outdoors with your wife and your family, I suppose. And also you're a property investor yourself. So I think you're undersold. I think we need to get Joe to write you a spiel, because I reckon there's a whole bunch of knowledge and wisdom that we could poke into that. But I want to ask you the question: what is something that we haven't mentioned there that you're really proud of that people don't know about you?
Well,
the Stig of property economics.
On the spot. I know,
I got to stop doing that, but it's kind of fun. we find out people are UFC fighters, and we find out all sorts of kind of secrets. Like, what is one thing?
That I'm proud of that wasn't in there.
Anything, it could be that you walk.
What was one of your big achievements in the military?
Yeah.
Well, I pretty much originally joined to go overseas, and I did that a number of times. I served in Afghanistan and Iraq majority of the time. So that was like going over there, doing that work, and then sort of having a bit more of a broader understanding and appreciation for the world was definitely something cool. And then obviously having a pretty solid foundation back home here to raise the kids when I was gone was also like something that was unreal. So it's definitely like my success has also been part of sort of my partner's success as well, really. So it's been a wicked decade or more.
Yeah. Sensational. What are some of the things that you can take? from the military into property investing? Like are there things that you're like, yeah, this has actually really helped me along the journey?
Probably just being disciplined, analytical, and having conviction in what you do. So like I look at property investing. I look at all other investments that I've sort of looked at, and when the numbers just worked, then that took all the emotion out of it for me. And I just thought, well, what am I waiting for? Essentially, like it looks good, then let's get on with it. So having a bit of having that conviction is definitely something that I think that holds a lot of people back. They either get in and then they get out real quick because they're not fully committed, or they just don't bother at all.
Yeah, I totally see that. How can someone who's not as convicted, right, who isn't like that generally, how can they foster that in themselves, or is it an inborn thing?
No, it's probably definitely taught. I reckon that you could become a lot better with education and just broadening your knowledge. So read a lot more, meet a lot more people, expand your network.
Subscribe to the Oz Property Investors YouTube channel.
Yep.
Well, that'll give you the discipline and conviction you need. I don't know, maybe have 5 Weet-Bix a day as well. That's kind of my secret, I think. But no, look, that's a really kind of it's something that's it's really fantastic you've done that, because I had a pop served in World War II in New Guinea, and walking the Kokoda Trail, it just gives you that absolute appreciation and kind of absolutely no understanding what the people, anybody who's sort of served and done that, had gone through. But it was epic to be able to have done that, to have the discipline and conviction, and just the discipline as well. So a thing that's dovetailing into our first question on the show, the thing we love asking people is what their first investment was, or how it all went down. Like, tell us all about that.
Investment property.
Yeah, investment property.
Yeah. So my investment property, I think, is a very similar story to a lot of people, and that's I brought my own home, put no research into it. I brought on emotion, and so did my wife at the time. And at the time I was like, this is it. This is a forever home. Love it. I brought up in Townsville for a start. So if anyone knows the Townsville area, probably not the best location for investment. I lived in there for 11 months, I'm pretty sure. 11 months I was there for. And then I moved down to Melbourne. And then I turned that into an investment property, and I've still got it today. Probably not the best idea. Looking back on it, I would have done things a whole bunch different. But then that was in 2012. And then I had a good sort of 5 to 6 years before I started to actually look at, hey, I need to start investing and doing something for a vast number of reasons. And that was, the portfolio really started, I think, the investment mindset kind of started around that 2018 for me.
Yeah, that's nice.
That's interesting. What is it that kind of, was there an aha moment, or what was the thing that kicked you into investing? Like, what did you decide?
I guess it kind of was. So for me, I didn't necessarily have a hard on for real estate, like bricks and mortar. It was not like really something that I looked at and went, yes, this is what I'm going to do. What I was trying to do, the more that I read, the more that I researched, the more I looked into like how banks lend, what their appetite is for property. It just kind of seemed like the most, apart from looking at stocks, bonds, savings accounts, and Dolomite accounts, trying to use my kids as much as I could.
They still do that?
No, I think they might have got rid of it. I don't know. But at the time, I was kind of looking at everything, and then I sort of went, well, property for me seemed, at least in Australia, to be an asset that can be highly leveraged, which I liked at the time. And I looked at my age and thought, well, hey, I've got enough time here to have a higher risk appetite than someone that's, say, 40 years old. I then kind of looked at the performance of property in Australia and said, well, okay, it's mostly outpaced CPI or inflation, and it's also kept up with the debasement of our currency in Australia. I then also looked at the government side and thought, well, okay, government seemed to really like to backstop this asset. I think they enjoy the wealth effect that it created for people that held it, and they needed investors in Australia, which is very different to how sort of investment housing worked in somewhere like the UK.
Or even the US as well, I suppose.
Or even in the US, mate. Yeah. So we're definitely better at managing a business or running a business than the government, I think. And we can look at the spending habits of most governments to sort of reinforce that statement. But for me, it seemed like their narrative was always to increase costs, increase access to property rather than decrease the cost, because it was sort of, by that I mean it appeared more affordable but not necessarily more cheap. So if that was an asset class that was controlled like that by the government, then I thought, well, this is beautiful. Like, I can leverage this thing up and I can get a good return, and that's kind of where I fell into it.
Yeah, nice. That lends itself quite nicely into some of the concepts that we're going to be talking to tonight. So I'll let Joe, I mean, Joe loves asking these kind of questions. So I want to hear what kind of questions Joe wants to ask.
Mate, I've got a question around how's the property gone for you in Townsville? So you bought it 2012, so it's now 10 years ago. How is that kind of what would you say it's worth now? Would you say 250 or something?
Yeah, so I bought it for 400.
Oh,
no,
sorry.
No, I didn't. I bought it for 440, and the last valuation I had done on it was 435, and that was, I held it for 8 years, so 8-9 years. So was
interesting.
And then my recent, I brought one in. I ended up buying a property in Geelong or Whittington. I don't know if anyone knows where Whittington is. Yeah. But like, not historically a very good area, but it was like I spoke to mates of mine that I worked with, and they were like, "Dude, I'm from Whittington. You don't want to buy in Whittington." And it was a lot of old housing commission. But I brought that in 2019 for 365, and it's valued at 520. So over So that was
That's amazing. That's sensational returns, and I guess that's the proof in the pudding in terms of asset location, right? Location selection rather than just kind of throwing a dart at the map. And it's interesting that the last valuation, even with this massive boom, that Townsville hasn't picked up and even given you anything over that period.
It probably went backwards, and now it's it has increased back to roughly where it was, I would say. Correct me if I'm wrong.
Oh, yeah, for sure.
It did. I'm pretty sure that I'd have to look at the Townsville market house price, but I'm pretty certain that, like, I brought in 2012, which was like, if not at the peak, it was just starting to dip down, and then it went. I'm pretty sure it went down to like 390 maybe. At some point, I looked at it, I thought, but then you're right. It just eventually recovered, and that's just definitely highlights the fact that, like you said, Joe, location does most of the heavy lifting, as everyone sort of says. So it's definitely true. It was a nice house. There's nothing wrong with it. It's a real beautiful home. It was relatively new. I think it was built in 2007 or 8. But it just was, there's too much land up there, and the demographics aren't exactly there.
Yeah. Okay, Jeff.
Yeah. I was going to say, let's get cracking on the what we promised. We promised an economic masterclass. So let's talk to some of those terms. So we've got things like interest rates, we've got inflation, we've got wage growth, and we've got the major players. So just kind of for the people who kind of didn't study economics, or even sort of give us a very very straightforward answer on what is inflation like, and give us some of the couple of different parts of inflation as well.
So
PI versus asset price inflation.
Yeah. So in my mind, there's kind of this inflation is all subjective to who you're talking to, because if we measure inflation by a group of things that people buy, well, then what do I buy? Like, if I want to buy houses, well, then my inflation is actually, like, this year is like probably 20%. Then you've got other government bodies that will say inflation is 2 or 3%. But then, that probably rings true if you don't need to go and eat, or if you don't need any electricity or anything else to live. You probably are experiencing like an environment of sort of low inflation. But I look at it as being like 3 different types of inflation. There's CPI, and I can sort of bring up the website and show exactly what that CPI is and what it's sort of constructed of. So there's that. There's also non-CPI assets, so things that aren't actually captured in this basket of goods that that the Australian Bureau of Statistics capture. And then there's inflation. Then there's inflation in our money. So we have like base money, and then we have broad money that's in the economy, and then we also through lending, through banks creating money, we have a inflation in our money supply. So there's kind of like if you're looking at inflation, the most common thing that always gets reported in the headlines is CPI inflation. So there is a chart here. If I can just quickly share my screen.
What's you getting chart up? Has there ever been a time where the supply of money has actually decreased, or has that just never happened?
There are deleveraging events where money will decrease, and that has happened. I can bring up charts and we can have a look at that as to when that happened and why. But like if you think of like bad loans, if there's a bad loan made, then what happens to the loan? We have or in fact the loan is repaid. So if you go back to your bank and you repay your debt, then you've just removed credit from the economy. So you've kind of
right.
So let's have a quick look.
So is inflation good or bad for the economy?
An interesting question, Joe. I like that one.
Depends who you ask, I suppose. Depends who you ask. I mean, for property, I want to come back to that because there is a good chart for just for property. So if we talk about the economy, I guess you could say that no one likes to pay more for things, right? I don't. You don't. No one really does like to pay more for things.
Even bacon rolls have been going up. It makes me sad. It doesn't make me happy. Yeah.
So, I mean, that's I don't really see that as a good thing, but certain people will say that it is evil necessity. If we keep it at this low rate, then everyone grows, everyone's happy, everyone gets more income, yada yada yada. But that's not always true, and there's been some cases where you get high inflation, and what usually accompanies high inflation doesn't exist, or in the inverse, you get low inflation, and things that normally accompany low inflation also don't exist. So, I want to try and bring up
the chart.
Yeah.
Bring it up. Let's get the crystal ball out for 2022 and beyond, because
entire screen. Yep. Now you're going to see a million tabs. You're going to see a lot of tabs because there's just too many here for me to just individually go through. So
you just got to click away from us and then.
Oh yeah.
Oh okay. Yeah. Let me just go to this one then. So here we go.
So you won't be able to see it, but we will.
Yeah.
Awesome. So coming back to your CPI, this is actually on the RBA's website. They've got under this education tab, they've got a whole bunch of resources, which is actually pretty good. I'm definitely a critic of most of the stuff that they come out with, just because their past predictions have been horribly wrong. And while I'm kind of on that narrative, I'll quickly divert and go to their wage price index forecast. So this is actually this is their predictions from 2011, and I'd love to actually chart this. I can't seem to find like a really up-to-date one. Maybe I'll just have to look at their past predictions and chart it myself. But this just shows that every year wage growth has gone down. But every single year since 2011, the RBA has predicted this is what's happening every single year. Up, going to go up. And there's kind of part of me that I know that people that make these decisions aren't dumb. It's more so that they're on this wheel of positivity all the time. They're in their positions for a short period of time, and it's easier to pass a hot potato to somebody else rather than actually stand up and say, like, raise real questions like, is the debt levels that we're at and going to sustainable? What does that sort of mean for the future? What do rates look like in the future? Is this sustainable? And I mean, this to me just says either their modelling is broken or they're just in this positive echo chamber of rubbish.
Or is it just too hard to predict? I mean, are they trying to rationalize something that's actually irrational?
Yeah, I mean, it's all based on human modeling, isn't it? So you feed into computer gives you something out. So
yeah. So what does wage price index have to do with inflation?
Well, the wage price index really ties into first of all, if you've got inflation at 2%, let's say, and then you've got wages growing at 2%, well then you go nowhere. Like if you have, that's not necessarily a really bad problem. The inverse, though, is that, or the opposite is, another scenario would be if you have inflation at 3%, like we could do now. I think it's recently it was 3.8 because of sort of fuel, food, and energy and commodities. If you're running inflation at 3.8, but your wages are only increasing by 2%, then you're actually taking like a 1.8. You're minus 1.8. You know what I mean? And you're kind of going backwards.
Losing.
Now that's
you can't keep doing that.
So that's okay for a short period of time, but you do that over a long period of time, and that then ties into. I know there is a small clip here of on the topic. This APRA crackdown on lending. So they're talking about debt to income ratios greater than 4 times or 6 times being capped. So if you look at an average Australian income, might be somewhere around, I haven't checked recently, but it might be somewhere around 80 grand a year, let's say. So that's then a problem, because if you can only borrow 6 times your income and APRA says we're going to cap lending at 6 times 80 grand, well, what's that, 480 grand? That's all you can lend. So if you then suppress wages for a long period of time, how do you grow? How does the housing market grow? How does the economy grow? You kind of can't. So that's where it's important, and things that have kind of dropped this down. And I'm like, I'll catalyst everything that I say with. I barely passed year 10 and I'm a moron, so don't believe anything that I say. But my general opinion of this is that we've got globalization, we have advancements in technology, and in Australia we did have a lot of migration interest or immigration into Australia, which then typically does suppress wage growth. So that's what we've kind of seen since 2005 is a natural trend. And I just like to look at. I'll catalyst things with. I can't predict things over the 1 to 3 years, but over the long term, I just like to look at, well, this is a downtrend to me, and it might slowly come up here, but this over a long period of time is definitely signaling lower and lower and lower, and that can be seen over not really inflation. Inflation generally has sat between a band of sort of that 2 to 3% or just under for a period of time. But you're looking at interest rates, you're looking at the cost that governments or the 3 and 10 year bond rates, for example. So the cost that governments pay on their debt, it's all has been trending down since 70s, 80s. So I find that quite interesting. Of a longer term trend for me is a bit more certainty.
Can you give us a high level overview of like who and what APRA is? Because we've got these key players in the game. We've got the RBA, and they're always talking about interest rates and the monetary supply. And then we've got we're talking about inflation, and we've got wage growth, and then we've also got APRA. How do they play in to all of this stuff?
Well, but before we should actually expand the acronyms here, because acronyms kind of shit me sometimes. So RBA is the Reserve Bank of Australia, people don't know, and APRA is Australian Prudential Regulatory Authority. So they're the kind of bodies that, and so what? Yeah, tell us now what they actually. There you go. You've got a definition of what they do. We can see
your notes, by the way.
That's it. That's in
there.
No,
I reckon it's worthwhile seeing it.
Yeah. No, these are so I wrote this down exactly for this reason. So they're the independent statutory body that supervises the banking, insurance, and superannuation. So I'll put here that these kind of the guys are the I like to think of them as the gas pedal or the brake on a car. So if your credit policy gets too tight, then banks aren't exactly lending for a number of reasons. Like it could be heaps of risk in housing, there could be risk in other assets. So they then contract, and then APRA comes in. But they generally have come in more recent times around areas that where they've identified risk, and that seems to be their most favourable kind of area to influence. They've come in with, I just shown the article there about the potential of capping debt to income ratios for lenders. They've come in recently with the service buffer increase to, or the buffer increase on rates. So you now no longer can, not getting 2.5% added onto your interest rate. You're actually getting 3%, which then just reduces your borrowing capacity a little bit more, just to try and start off excessive risk in the housing market.
So their job is to ensure that everything stays okay. We're not going to be going way too far out, and the property market is going to be not this thing that's just going to take off like a rocket ship forever into eternity, because we need to protect the market that we have.
Well, so Joe, APRA doesn't. I mean, they don't regulate anything to do with. I mean, correct me if I'm wrong here, Tom, but they won't regulate the housing market. They'll regulate the financial institution. So they'll say, okay,
and that's what the narrative has been. They have said that we do not go in and play with the property market.
But ultimately, though, if you're going to regulate the banks are the ones that lend people money to buy a property, right? So they kind of are indirectly, even if they say they aren't doing it. So. I mean, yeah.
I don't want to go sort of high level here, but this is kind of like when you talk about US central bank monetizing government debt. They aren't allowed to buy directly from the government, so they buy bonds via the commercial banking sector, which is kind of the same thing, because if I can't buy something from you, Joe, but then Jeff sells it to me anyway via you, it's kind of the same thing, but like exactly what you're saying. Yeah.
Exactly.
It's all the same.
So tell us so interest rates, because I want to make sure that the people out there are sort of thinking, okay, I want to think property, or not think property. Are not saying go and buy property. We're not saying don't buy property. You guys make your own decisions. But what I do want to ask is interest rates. What do you think about what interest rates have done and what they'll likely do based on what you've researched and looked at?
Yeah, let's go again and have a look at.
This is a question everybody wants to know. Like, where are we? Like, should we be worried about rate increases and the business cycle?
Oh, look at this! What was that thing?
So, which one? That one? That one? Okay, this actually this is a circular flow model. So if you think about there's a couple of good images out there on Google and whatever. Ray Dalio, you guys have talked about this before, I'm pretty sure. We'll do a wicked 30-minute basics or fundamentals of the economy video. So if anyone hasn't checked it out, go and check it out, because it's
100%.
It's dumb enough for me to understand. So it's good. But anyway, this one is very similar, but just the RBA have just given like a quick one slide thing here. It just shows, pardon me, that in the Australian economy, or in a normal economy, you have firms and sectors which pay wages towards household sectors. Household sectors then pay savings towards financial sector through investment. They then pay taxation to the government, and then the government obviously spends that money relatively quickly because they don't have any to begin with. The household sector then imports goods from the overseas sector, and the overseas sector export goods back obviously to Australia, back through businesses. So
I think I'm in the wrong. I think I'm in the wrong sector. I think I need to move across to the firm sector. It seems to be all the money's flowing towards the firms. Mostly.
Yeah. You can delete this. Yeah, you can delete that and just say, well, taxes come in and money goes here. Yeah. But rates. Where we're looking at rates. I did have something up here about rates. Maybe it's in one of my other 50 tabs. Ooh, that's okay. We can just use it. I actually quite like this website. It's a trading economics, so you can pop in any website, any country that you want to look at, and we want to look at Australian interest rates, and we can kind of make two assumptions from looking at this. Let's go max.
Wow.
So again, like I was saying, I like longer term trends, and what I kind of can see from this is that, obviously it's a no shit statement, the long-term trend of interest rates since the 1991 has been down. We tend to get there's two sort of things that I think about when I look at this, is that short-term. Where's this other one? 2 seconds. There's another one here. This one is good. So
here we go.
Median house price and home loan interest rates. So the two things I look at this is that when rates go lower, they go lower to stimulate growth in an economy, because whether there's been a crisis, whether key economic metrics aren't being met, so we go into this sort of cut rates. So we then cut rates, we get an expanding credit, economy starts to expand, and then inflation is supposed to generally start to pick up, which hasn't sort of been the case for a number of years, but inflation generally picks up, and then we try and increase rates to kind of put the brakes on the pedal, I guess. But I think one of the biggest issues we've had since we kind of went to this debt-based monetary system is that every time we cut rates, we just increase the level of debt exponentially. So households increase level of debt, businesses increase level of debt, governments exponentially increase their debt. The problem with that is that how do you increase rates again over an extended period of time? So we typically go, the rate increases seem to happen very sharply and seem to happen over like a 2-year period. So this looks like to me at 87 and sort of peaked at 89. Then it just dropped off massively off the back of large inflation of like the 70s and 80s sort of period. And we can overlay this with the US cash rate or interest rate as well, which you kind of get a very similar picture. So we then go down really quick and we go down like substantially. This was 16, nearly 17%, and we came down to like 9. And then that happens sort of over a couple of years. It generally happens over a few years and generally stays there for an extended period of time before going back up again. But the gap between the rise and the fall generally just seems to be another 2 years. So here is 93 and 95 and then another fall. We then have like 97 to like 99. And typically like, I think it's generally about 4 years of just stagnation of at whatever particular rate that is. And then we begin to rise again. And if we overlay this chart with inflation, you kind of see that's actually a really interesting chart. I'll show you that in a second, because you do see the correlation between inflation rising, rates rising, and then rates dropping and inflation dropping, or inflation dropping and then rates dropping up as a result. So
the question I want to throw out here, because I'm sort of seeing there's is it? I mean, I don't know. Is there actually a cycle with interest rates? Because I mean, I suppose that's the reason I'm asking that is because I'm looking at all these events here. That one where it dropped off the cliff a little bit was coincided somewhat with the 88 stock market crash that I think they call the Black Monday, where it dropped 20% in a day, where it was. You look at the 96, that's the Asian financial crisis, sort of 96, about 98 roughly that happened. And then you look the next big dip was even in 2000, that was the .com crash.
.com,
yeah. And then the next one was GFC. So and then the latest one, where we went from about sort of 3.5-4% to what we are now at 0.1%, which was COVID, or it's COVID, I suppose. That was the catalyst. But is it what is causing? Is there a cycle, or is it just purely reactionary?
Well, that's probably the $1 million question. I mean, anyone that's read anything from Dalio knows that he talks a lot about the short-term debt cycles, which are typically your 7 to 10 year cycle in rates, where rates do go down and then we normalize and we do come back up, and then we go down again at the end of that cycle. And then we have that longer-term debt cycle over 75 to 100 years, which we typically don't see because we all die before then, to really remember.
I'm planning to at least 100, so I should say at least one of them.
Yeah, but he definitely talks about at the end of that sort of 75 to 100 years, you get so much debt in the system that the only way forward is to continue going down and down and down, and you can't necessarily your time spent at higher rates is lower, and you get anyone that looks at sort of does chart analysis or TA for stocks or whatever would sort of say, well, this is a lower high than the previous high, and that's just a downtrend all the way. So I think there probably was a portion there where it was cyclical, and you can kind of see that here, and that there is a bit of a sort of a cycle there happening, but it's still, the long-term trend is still down. So I don't know how. The good thing there is that you can see this is the median house price for Australia, and it does only unfortunately go to 2017, but the rising rates hasn't necessarily impacted housing too much. Like we've got a massive rate rise here, and what happened is property went up still, and then we had a rate rise here and property still went up, and then we had the cost of money get cheaper and property went higher, and then what we've had in the last couple of years has been exactly the same. I'm pretty sure that it was the RBA that actually had a study a few years ago that said for every 1% decrease in interest rates, you get a 25 to 30% increase in property prices. I'm trying to. Sorry,
I heard something about that. Yeah.
Well, it makes sense. It makes perfect sense. Well, does that make sense to you guys? Like interest rates drop.
Yeah.
Well, yeah. Does it make sense to the audience? But I was looking at this previously, like just before we came onto the show. If you had a $400,000 property at 2.5% interest rate,
yep,
you'd be paying $1,800. with a 3.5% interest rate, you'd be paying $2,012. For the if you have the 2.5% raise, you could spend $450,000 because the interest rate is cheaper. So you could actually have more money available to spend, because obviously your $1,800. Oh, well, instead of being 3.5, it's now 2.5. So it means I can spend that extra $200 a month. I'm gonna
throw a cat amongst the pigeons there, Joe, because I heard somebody talk about this on a podcast. In theory, yes, what you're saying does make sense. However, the assumption is that you can still access credit. So, I don't know if anybody charted kind of interest rates versus ability to borrowing capacity kind of things. Because obviously reducing rates means you should, in theory, be able to borrow more, but then do they become more conservative with regulation? So, do you have any kind of, you probably don't have charts on that for you, Tommy?
I'd love to see a chart on monetary intervention as rather than interest rates.
So you're talking about so there is, I've got two things and I'll come back to them, but let's do
well, we're making you jump all over the place here. If people are loving this, I want you to put money in the comments or throw us a question, folks, because there's heaps of people watching, and I know we're looking up Angola, and Angola's a pretty cool place, isn't it?
So this is a little bit unfortunate because the RBA, I don't know exactly why, but they stopped reporting on their broad money, or their M2, which is the money in the economy.
Taking it behind the scenes.
Yeah. So, but what I have done is I have looked at the increase in broad money in the economy in the United States, and then I've done another chart here in the UK, and then the only other one that we can look at here to compare it to is the house price index. Let's go.
What does broad money mean? Is that?
So you've got base money, which is like your cash and reserves at the bank, reserves that are held at the central bank. Then you have broad money, which is everything else. So think of all the broad money is all the other money in the economy, including all deposits. So you typically get a large increase in broad money in America. One big common myth, and it was a myth until about last year, is that when central banks do quantitative easing, when they buy or they purchase assets from commercial banks, or they purchase government bonds through commercial banks to try and provide liquidity to the market, they say, well, they're causing inflation because they're printing money. And you're like, yes, they are creating money out of thin air, yes. But what you can see, and again, I'm going to jump over the place slightly here, is the effect this is in Australia, by the way, for the RBA. You can see where that money's actually gone, at least for the bond purchases. So it doesn't make its way into the real economy, at least until last year, and I'll explain why. But one of their charts here, RBA assets. So from 14-15 all the way through to 2021, this is what the RBA sort of held on their balance sheet. And the biggest thing has been, the biggest one sort of looking at here is domestic bonds. Other one is the exchange settlement balances. So when we went to COVID, all we've done is just buy an absolute shitload of government bonds, and we do this because we want to keep rates low. So if there's, all the viewers can probably relate to the fact that if there was 10 houses available for sale and they were available for sale for $1 million, and everyone could kind of afford $1 million, you've got a bit of competition there. But then if the RBA came in and said, we'll buy the house and we'll buy it at any price, well, then the house wouldn't be worth $1 million anymore. So it'd probably go up substantially because everyone would then just sell their house straight to a central bank. So what they actually do is they've been buying these bonds from government and from commercial banks to try and keep the yields low or interest rates low through the economy. And when they've done that, they've brought sort of, what's this, 200 to 500 maybe, so to call it $300 billion worth of bonds over that period. And all that money is now, it's an asset on the bank's balance sheet, on the commercial bank's, the central bank's balance sheet, but then it also has become a liability. So all they've done is they've created money out of thin air and then put that into bank reserves. So that bank reserves can't be lent out into the real economy. So they can be lent to bank, but they can't actually be just given out and gone and buy and whatever they want. The common narrative seems to be create print money out of thin and buy.
I think I need to have a conversation with Glenn Stevens about if I can get access to some of this money they've got tucked in there. Because seems like there's some big money that we could. Yeah, no, I'm talking absolute rubbish here.
So what does this actually mean, right? So the RBA has been buying a boatload of bonds from, and what does it actually mean? So their goal is to increase wages, but inflation is starting to creep up, and they can't. Apparently, APRA can't touch the property market, but it messes around with the banks. It kind of makes sense to lift, like I see it kind of making sense to lift interest rates. Like, doesn't that make sense?
No.
Why would it not? Why would they not?
Because then you have to. I mean, I'm interested in Tom's thoughts on this as well. Because then the problem is they've created all this debt, right? And they've got to repay. I mean, I suppose if you're repaying yourself, doesn't really matter. Maybe not. But I suppose it depends on who the debt is to. Because if you raise interest rates 0.5%, then your debt, you've borrowed debt at you've increased your you've increased your repayments, right? So then how do you repay it if you don't have do you create more money? I mean, I don't know, but then it's.
You look at that raises a good point, because it makes sense to increase rates, absolutely, because even by the RBA's own chart here, they will actually say that when an economy expands, production increases, unemployment decreases, wages increase, consumer spending increases, and then prices increase. And it says down the bottom, even in their own charts, that if the economy is expanding too quickly and there's a risk of overheating, then the Reserve Bank may increase rates to slow down the economy. Now, that makes all perfect sense. But then, again,
the economy's not crushing it. We're not crushing it right now. Our employment levels are very low.
Yes, and the other thing is we need to look at where the inflation is and why. So if the whole narrative around this transitory inflation is interesting, because, I mean, like we've already discussed before, there's many ways you can measure inflation. If you measure goods that some people may or may not buy, then your inflation rate might be low. But I don't necessarily agree that the economy is in the greatest shape, and I don't see how you can continually cut rates, go into further debt, and then increase it substantially. Like they're predicting in the US that they're going to have 3 rate hikes next year and another 3 the year after. So they're going to say like 3%. It's like I'm looking at their let's have a look at their government debt. It's something around $30 trillion. So I look at that 30 trillion and say, well, if you increase the repayments, and by the way, they're running a $3 trillion deficit. So this year alone. So if you're running a $3 trillion deficit and you're at $30 trillion of debt, you increase rates by 100 basis points. Well, you've just increased your repayments. And as you said, that's perfectly fine, because for a government, well, if my debt just increases and my repayments increase, then I just sell more bonds and I get more money to meet the obligations of the debt. But for businesses, large business at the moment are financing debt around like the 1.5% mark, and for households, we don't have the benefit of doing that. So you then crush the economy by doing so. So again, I'm looking longer term. I think between the next 1 and 3 years, who knows? Maybe rates do increase slightly. Maybe they go up 25 to 50 basis points. But I think longer term, the charts sort of show that the trend is definitely down, which makes sense, because we're in a debt-based monetary system. Credit expansion is what we want. We want growth, so we cut rates. We go into more debt. We cut rates more. It just seems to be the cycle.
Yeah, that's interesting. So if I'm a property kind of investor, and I'm sort of thinking, oh, this is all great, but how should I sort of? I mean, everybody's got to make their own moves, but what are some tools, I suppose, you can consider to, if you don't want to go and read all these charts and read all these graphs and say, what should I consider to kind of read the tea leaves without actually having to understand all of this? Is there a way to do it?
Well, I'd probably just summarize that property is definitely a game of credit policy and solely credit policy. Like you can, there's not much else you can. There's a few things that you can do to ensure that in the near future that you can actually continue to lend, and you can increase your chances of being able to lend. But I think that as you continue to debase a currency and increase the supply, you're going to have an increase in housing. But housing can only go so far for so long. I think that what we might see in the future is longer loan terms, because again, like I was saying, with the government trying to increase accessibility and not necessarily decrease cost of the asset. I think that one of the ways that they could do that is they could look to, I'm pretty sure it's Switzerland or Sweden, but they've got 100-year mortgages. I'm not exactly too sure how that works, but even if we increased it to 40 years or 50 years, your monthly repayments would then drop substantially. So now it becomes more affordable. But then to do that, you'd have to remove your debt to income caps, because if you're capping everyone's lending at 6 times their income, well then how does property grow? How do you go to $2 million property? You can't. So,
well, I mean, like my answer to that question, Jeff, is like factor in your build buffers, right? Like build in and purchase properties that are actually going to go up in value, but also that have value add, and that also have some cash flow to support it, right? Like don't just keep chasing this growth. And I think people look at a property portfolio and they look at a property, but they don't look at their overall portfolio and how everything meshes together. So you've got to you do need growth, but you also do need the cash flow. But do they have to be in the same property? No, you can have one property here that is for growth that might have some extra value add down the line, and another one there that is for the cash flow. But it's building in to the situation, extra equity, get creative. Like I think there's some great opportunities there, but just don't over leverage too much to where if it does raise 1%, then you're in trouble. How about you just try and factor in an extra percentage point and run the numbers at that? Well, that was a question for you, mate. But
is that a question for me or for Tom?
No, that wasn't a question. That wasn't a question. But I mean, that's kind of the way you do it, right? If this stuff is all, if it's going to go down that direction, factor that stuff in, build in your portfolio. Like how do people, I guess maybe from a broking standpoint, you can talk to this. How do people, make a more bulletproof portfolio, do you think? What are some of the things that they can do?
Well, so I share like a pretty common theme that I've seen with clients has been, why can't I lend anymore? I've got $800,000 in equity, and you're like, yeah, dude, but your wife just went on maternity leave and you're on $80,000 a year with 3 kids. Like, so there's
how are you affording that? I mean, that's you got privacy.
But there's this concept that like I'm very rich on paper and I should be able to loan more because I've got $800,000 in equity. I can sell my house tomorrow and I can go and buy it outright. I know, but unfortunately, the way this works is it works on income. And like you just said, Joe, the number one thing you can do is increase your income. And it's the number one thing you can do, but it's also the hardest. So like I've actually looked to in that I've got like a little e-commerce store that I started 12 months ago. But for me, I looked at that as a play, and that probably only makes gross like 15 to 20 grand a year in sales. So, but I looked at that as a play of like, if I could register the ABN and I can have the business at least for the next 2 years, in 2 years' time, I could use that income and 10 grand worth of income. And a friend of mine actually wanted to try and look for what his maximum borrowing capacity was for a property. Very similar story, wife on maternity leave, 2 kids, and he's got a pretty good income himself, but he was capped at, I think, 550 grand. And then all we did is put his wife in for 10 grand a year, 10 grand gross. And it went to 730. So I was like, dude, you've just made another, substantial amount of money. It was 550 to 730 is 180 grand. just by getting 10 grand
because
more.
that extra 10 grand is tax free. You know, kind of adding 10 grand to his income is not necessarily going to be as helpful because he's going to be at, I don't know, whatever 32% tax rate, which means he's only going to get 6,800 of it.
But for him, he was like, well, I said 10 grand a year is only like $150 a week. So could she go and work part time for a day, casual for a day? These are all sort of ways that I think you can better increase your chances, cut your spending, look at at least do a little bit of for planning, have a good savings plan. Don't go ringing banks or ringing brokers and saying, "Oh, $3,000 and I really want to invest in property." It's great that you're thinking of it, and maybe you should just engage someone early and say, "Yep, well, hey, maybe not yet, but this is what you should be looking at early."
Yeah. Join the group. And then when you join this group, ask questions, get educated, and then when you've got a little bit of cash, then then you can chat.
That's it. Yeah. But yeah, these are definitely all sorts of ways that you can at least tidy up your finances. So don't have 10 bank accounts and 3 of them have never been used. Don't have your stupid credit card that you've just got and you don't ever use with the 10 grand limit. They're pretty simple things that I think not that many people are that educated on. And that's where I actually look at that and think I quite enjoy that. I quite enjoy working with investors mainly for the lending side, just because it's a bit more, I'd say obviously help anyone and everyone, but at the end of the day, I like hearing from investors. They've got different mentalities of doing certain things, certain ways that I certainly haven't thought of before. And it's a little bit less vanilla than the whole, I just want to buy my first home and can I get a loan sort of thing.
Yeah. And what do you see some of your more smarter or sophisticated investors doing that not everyone is doing? Like, are you seeing them fixing their rates? Are you seeing them doing something a bit different to what the others do?
Interest only or sort of doing a split? Like what's
I would say trusts are quite a big one for that. Definitely separate the investors from the standard run of the mill buying a home owner occupier.
Definitely, you'd hope so.
Yeah, for sure. Yeah. But that's
this is financial advice. Blah blah blah. Yeah, you know.
Of course. But I definitely see that, and I see that from a number of reasons, and in sort of not capping out your own personal borrowing capacity was one of those reasons. Recently, a lot of fixed when the RBA was doing their sort of 3-year or targeting the 3-year bond, and at 0.1%, substantially lowered funding costs. So I saw a lot of investors ringing up trying to go, hey man, I want to lock this in at 1.89. If rates are starting with a 1, then count me in for 2 or 3 years, which wasn't a bad decision at the time.
I recently see that fixed rates have sort of increased, so that's something that I think would be, it'd be interesting to unpack once we sort of get to the latter half of the show. So let's hold that off, because I'm sure people would love to hear that, and let's get into let's pay our fixed rate, let's pay our bills, I suppose, Joe.
This live session is sponsored by Scott Agate from Hello House. Scott has created the world's first property negotiation as a service business. So what does that mean? Well, let's think about it. When was the last time you negotiated on anything over $100, let alone a property that is going to be one of the biggest investments of your life? The vendor, they have a trained negotiator on their side in the form of a real estate agent. That's kind of like you stepping into the ring with Mike Tyson after never training a day of boxing in your life. These guys are trained professionals, and that's what they do day in and day out. And this is what Hello House does every single day as well. They negotiate on property to get the best buy price from the real estate agents. Scott Agate, he's the expert negotiator. He has been in this industry since 1995. He owned and operated 3 Bell franchises. Scott was the guy that was teaching these real estate agents all these agent games. He knows all of their tricks. Having him on your side is going to give you a massive unfair advantage and literally save you tens of thousands of dollars. Unlike other ways of purchasing property, Scott's incentives are aligned with you, the buyer, meaning the more money he saves you, the more money he makes, which is what you want. You need to have those incentives aligned. Scott has kindly offered our group a massive discount on the retainer fee for his service. So if you're looking to buy your next home or investment property, click the link below to get in touch.
Super, Joe. So yeah, that's we had some interesting questions pop in there, and I'd love to kind of unpack those. But what do you with those fixed rates rising? What do you sort of? I mean, if we get our crystal ball out and we look at kind of 3 to 5 years, you said the rates are long-term trending down. Where do you sort of see those going over the next 3 to 5 years?
Fixed rates?
Well, I suppose that's an interesting question, because when you look at fixed rates, typically that kind of gives a bit of an indication. So how do you tell? What kind of things do you look at?
It does give you an indication, but then again, you've also got manipulation of pricing. So there is a general long-term trend, and then there is things like let me just quickly share this statement.
Let's do it. Yeah, just.
Because I think this is pretty interesting to know. Yeah. So this is the in a nice to look at monetary policy and COVID-19. So this is the past sort of 2 years. Now, what's largely affected, in my belief, what's largely affected banks' fixed rates has been some of the stuff that the central bank's been doing. So they've got these asset purchases here. They've just said they're targeting the yield on the 3-year bond at 0.1%, expiring in 2024, and then they give a bit of an explanation as well right next to when they're saying, hey, we're actually buying $4 billion per week until mid-February 2022. The reason why we're doing this is make it easier to borrow and increase confidence to spend, and then lowering the whole structure of interest rates across the economy. So there's that portion there, and then there's also the term funding facility that came in last year as well, which was, I think, it was about $200 billion. Again, at 0.1.
I haven't heard of dot points, have they? Jeez, what they should really work on there.
Yeah. So this term funding facility allowed, and it even says lower cost of funding loans for the entire banking system, which will support supply of credit to businesses and households, and lower the interest rates they pay to borrow. So rates has historically been, at least fixed rates have been sort of higher than your variable, and then you would normally go in and say, well, what do I see happening here? Are they going lower? Are they going higher? I might just fix it a little bit more. Then we had this funding rates, just the floor just knocked out of it, and banks started offering lower and lower, and it's become very competitive. Sort of as I got down to 2, and now they've everything's normalised, and the government's gone away with targeting the yield on the 3-year. Funding costs have increased, and there is a obviously I should just leave the share screen on. Obviously, with all good charts, there is a good one on not funding costs, but I just had that before it got down. Yeah. So long-term interest rates and the 10-year.
Bit of a spike there, I can see.
Yes. Yeah. So there's a spike coming up here. So funding rates across the board have gone up, and they probably will continue to just normalise. They're not necessarily going up. They're just, if you suppress something for a short period of time and then you take the foot off the brake, so to speak, well then you're going to sort of normalise back to what you were pre-levels.
So what's this? Give us a run. Sorry, what are we looking at right now? So what's the black? The blue is interest rates, and the black.
The blue is interest rates, and the black is a 10-year government bond. So this is how they obviously government got 3 ways to fund themselves: increase taxes, which they don't do; cut spending, they also don't do; and then go into debt. So to go into debt, they need to offer these bonds, and this is this is essentially like some of the ways that banks fund themselves. And if that portion has gone up, then you'd expect interest rates to follow. But you can. So
that's exactly like you're talking about long-term trends. And this just followed interest rates, right? Like, look, it's just going down. But now we've got the black line starting to creep up.
Bit of a divergence.
Yeah.
A little bit of. So now the interest rates are really low, but the government spending isn't just going up by the looks of things. Yeah. It's got
there is one from AF. There is one from the AFR here, and it is a prediction only. But where's the photo? Come on, load. Hope it doesn't kick me out because I don't pay for it. Here, total government debt forecasted. So 2020 was like sort of 60% of GDP, 1.5 trillion, and this was kind of across states and Commonwealth, so federal and state debt. And if that's forecasted to grow all the way to 2025 to be nearly 90% of GDP and over $2 trillion, then something's kind of got to give. The reason why this has actually spiked is because everyone says, "Oh, well, funding costs go up, and this is why rates will follow." Well, this is actually spiked because a lot of the times it's been going lower because inflation has kind of just sat between this band of 2 to 3% and gone lower. So when investors look to deploy capital, they look to deploy capital to an area that they know in 10 years' time, when I get the money back, it's going to be worth something. So if we've got a little bit of inflation happening now, which I sort of do agree that's transitory, but how long is transitory? Because, life is pretty transitory. So,
damn it, mate! I thought it was going to live forever. You spoiler alert, like
yeah. So I don't know how that plays out, but to answer your question on rates, I think we at least have a normalization of fixed rates, and then I think it's just going to continue its downhill trend.
Well, because if I look at between probably about 2017 to about 2020 or whatever that is, so you see the blue line sort of sat at about 2%, whereas your government bonds, is that a yield? The government bond yield, I suppose.
It's the yield, mate. Yeah.
It's the yield. Yeah. So 10-year yield is sort of sat at about 2.75. Let's call it close to 3, maybe not 3. So you can sort of say that it can sit at that level, right? I mean, I suppose potentially you see the government bond yield reduce again, maybe.
Mm-hmm. Mm-hmm.
I mean, so yeah, I think it doesn't necessarily mean rates will go up, but yeah, I'm going to find it hard to see rates increases, but I'm not saying it won't happen, but I just think it's going to be hard because you unless you sort of start to see because overlay all this gross domestic product. What does our GDP kind of look like over the last? It hasn't looked great, has it? GDP.
Debt's GDP or just GDP in general? I actually think it's that thing. I mean, let's have a look.
Just GDP in general. Yeah. What is
There was a negative period, or maybe
we went into a recession last year because those two kind of.
And you're probably talking about annual growth, right?
Yeah, year on year.
Yep. So I think everything right now is just the narrative is around this sort of supply chain shortage and inflation in certain key areas that I reckon is all going to sort of dwindle off and it kind of hurts me to say, but there's like predictions from the RBA that I kind of like agree with somewhere here. Oh man, I just got to get rid of these tabs. Here we go. So this is actually their forecast from November, their central scenario that they call it. And one of the kickers for interest rates was that we want to see inflation sort of maybe it goes a little bit higher, but it should be within band of that 2 to 3% mark, and our wages should be at least starting with a 3. So these guys have got inflation at 3.8 right now, and then trending down. So normalising by kind of June next year, and then they've also got their wage price index starting with a 3 in 2023. So if you want to talk about like rates, variable rates moving at all, the cash rate moving at all, then probably I in this scenario I'd at least agree with the central with the RBA.
So hang on, what are we looking at here? So public demand. So what's relative here to property? Let's get rid of our faces. Yeah. What would you say would be relative to property?
Relative or relevant, you mean?
Relevant or relative?
Well, relative would be what inflation does and wage growth does. So because realistically we're looking at what rates do in the long term, or at least in the short term, I suppose. And then we want to look at unemployment rate. So I'm definitely not looking like micro level here, but like a lot of guys that invest in property that get right down into the weeds definitely look at unemployment rates for those areas, and then in general for the whole nation. So that definitely plays a bit of a kicker. And then probably real household disposable income. Like if I'm looking at this is ultimately what
doesn't really seem to be a lot of growth in householding disposable income, does it? That's
yeah, but that was forecast, and that was like 16%, like last year. and it's forecast to be.
That was savings rate though, isn't it?
Savings ratio. You're talking about. You're talking about savings, yeah. So
savings. Okay.
Savings, which is interesting.
Rate? Yeah.
What was that?
Yeah, there you go.
Yeah, what's the difference between savings rate versus disposable income? Because you kind of think if you're saving, then surely that's disposable income. Like, I don't know. I'm just a bit confused on the definitions here.
Yeah, well, I mean, your household disposable income. No, you probably got me there.
Yeah, no, I'm not. Yeah, I'm just. We need to get somebody from the RBA on here to kind of tell us how.
I guess disposable income, whatever metric they're using for disposable income would be like, if I've got $100,000 and then after all expenses, I'm really only left with 20. Well, that's disposable income. Whereas savings ratio is if the average income is $80,000 and I'm saving 8%, like for the this sort of long-term trend. But yeah, you're saving bugger all. And then lockdowns, bam, everyone saved heaps. Lockdowns came off. Everyone spent a lot of money on things because that's what consumers do. And then went back into lockdown, had a lot of government stimulus. So
I think the answer to that is they probably don't consider. I mean, I don't know for sure, but I'd imagine they don't consider savings as disposable income because people have already factored that into the money that's they're not. It's not disposable. It's not money that's going to go down to the local pub or the local takeaway and spend it. They're going to sock it away in their bank account because they're concerned about there's fear and uncertainty. So they're sort of saying, okay, I might lose my job. I'm not gonna go and blow that at the local hair salon or whatever it is. I'm gonna save that. I'm gonna intentionally save it. So it's not disposable because I've already accounted for it somewhere. So I imagine they probably
So what? Can you? This is a good screen. Just scroll down a little bit, because what? Can we have a look back at why we had a massive boom in property? Is there data in here that shows us that? Because I'm looking at interest. I mean, I don't know. Maybe some of the obvious ones obviously are low interest rates and a massive saving ratio, demand increasing, supply. I was hoping that the private residential building approvals could tell us a bit of a story around the supply side of things. But is there anything here that you can talk to that indicated this boom?
No, I mean there's probably something here that has supply, which is obviously all the that if there's houses on the market and there's still the same demand, then obviously you're going to get massive increases in what asking prices are. But yeah, like I said, man, I'm a dude that barely passed year 10, so there probably is, mate, but I just
it's not your mega focus.
But I mean, it's obvious that you just said like you cut the cost of money substantially. So you go from 4% to rates sort of go from mid 3s down to 2. Then it's a no-brainer that everyone rushes to the bank to buy housing, and then it's a feedback loop of this like houses are going to go up, houses are going to go up. Oh shit! Well then I better go out and buy a house, and I was going to wait a year. Now I'm not. I'm just going to go buy it. And then you've got first home loan deposit scheme with that's definitely a government policy that pushes prices up. You've got the 2% deposit for single parents. Again, another government policy that increases demand for housing. So that probably all just came at the wrong time, to be honest. But it's worldwide.
Home loan commitment.
Yep.
Look, you can just see it all. Just look at it.
Excluding refinancing. So new home loan commitments, total, bam, up massively. So went from 17 billion to nearly 32 billion. And then slightly kind of get back down.
I suppose the challenge, Joe, is trying to overlay the macro with the micro, because it's often these kind of things. It's like moving the Titanic. So you're not going to, by the time you've seen loan commitments have doubled, not doubled, but that's a percentage or whatever it is. It's in billions of dollars. But by the time you've seen that, you've already seen potentially 20 to 30 to 40% growth in some markets. A lot of markets. So that's
and this house prices in general, the percentage change is almost like if you looked at if you overlaid that with that, it's not massively similar, but it's not too dissimilar. Like you've had this massive run up here, You've got a couple of sort of peaks and troughs here, same. This is a bit of the red herring though. That doesn't exactly exist, although it's maybe just zoomed out a little bit. I'm not entirely sure, but
yeah, that one ends at 2009, and that one ends at 2004 by the looks of things, or 3.
True. Yeah.
So that would be that peak there. Yep.
House prices to income's an interesting one. Since 91, obviously just gone. The higher house prices go, the higher your sort of house price to income ratio is going to go, and it's almost at 6. So again, how do you keep buying real estate that keeps increasing if we can't lend any more than 6 times your income unless you increase your income, which doesn't seem to be happening that much. So that's interesting.
So with when it says to increase income, does that mean we can, if we have properties that are a higher yield that are providing more cash flow, is that going to help increase our income to allow us to borrow some more?
Yeah, definitely. Definitely.
Okay.
If you if you're looking at if you look at a servicing calculator for a lender and you put in there that you've got negative gearing benefits are going to come in, but if you buy cash flow positive or cash positive real estate, then it's obviously going to go. It might get shaded. It might go down to 80%. Might go down to 70% of total income or total rental income. But at the end of the day, 70% of 30 grand is better than 100% of 0. So, absolutely.
Yeah, interesting. Well, that's the way to do it. Get a raise, get a better job, and then buy cash flow only properties. No,
cut those expenses as well, I suppose, as much as you can.
Not cash flow only properties. You need that growth. There needs to be something there. But this is where this kind of like value add kind of potential comes in. Okay, well let's jump to some of the questions because there's been some interesting ones here. Or Jeff, have you got any other?
I do. Let's throw the live questions and if there's any more kind of live, throw those in, whether it be about mortgage broking, the economy, and any of those kind of. Let's get a broad spectrum of questions, but we'll throw to some of these. So the first one I'll get up on screen. It's one that was asked by, I'm just trying to think, by Quok, who Quok asked, do you think, I think we've sort of answered this, but I'll get it up anyway, because do you think we'll get an official answer on this, we'll hold the interest rates until their 2024 target, although we're forced to increase earlier? Or are banks raising interest rates independent of official rates? Well, I don't know, that's kind of 2 questions in one. What do you think?
I think that banks raising rates independently. Yes, out of cycle rate rises are a thing, at least for the fixed markets. I've received a number of emails, maybe not of late, like maybe not the last 2 weeks, but certainly going into late October, early November. Standard variables had come down, like not substantially, but standard variables were kind of. I was getting emails a couple every week just saying, "Hey, just letting you know that we've cut our standard variable rate on this product and that product and that product." So rates were kind of coming down a little bit, even though we hadn't had any changes in the cash rate. At the same time that fixed rates were going up, but again, a lot of people get their information from the narrative that the media are portraying, and that is a lot of doom and gloom. Fixed rates are right, or they just say rates are rising. And yes, we have out of cycle rate rises, and that's probably going to continue. Do I think RBA will hold rates until the 2024 target? I don't like 1 to 3 year projections. I much prefer 10. And the answer, what would it look like in 10 years? I think we're 0 or negative. And
in 10 years' time.
Yeah.
Jeez. Okay. Wow, mate. I mean, that's interesting, because if we, because I can see why it would happen, or why it could potentially happen, is because of the amount of debt. We've somewhat painted ourselves into a corner, but I suppose the only way you sort of potentially slow down. I mean, it depends on whether you argue that inflation is transitory or not. Because if you can, let's just say that because the US just saw CPI of 6.8% or whatever it is in the year-on-year kind of inflation, the highest in 40 years. If that continues for any kind of period of time, I just don't know how they can jawbone as much. When I say jawbone, RBA couldn't organise sausages. Well, later on from Chris. I used to work with Chris actually, a really really cool interesting bloke. He's St George supporter, I think. But yeah, and I'll get rid of that one as well. But yeah, so I just don't know how they can continue to, or how long they can put off increasing interest rates in the US. And if US goes up, I suppose if we stay low, that sort of means that we become internationally less competitive. So I mean, I don't know. I'm not necessarily disagreeing, but I'm just saying 2022 is going to be interesting.
It will be very interesting, and a lot of that is on the back of the Fed tapering. And they say tapering, but tapering means we're going to not buy $120 billion worth of.
We're going to buy $180 billion instead.
I think they've said 40. I think they'll complete their taper by March or April maybe. But at the end of the day, every time that we've seen them taper, the markets at writ large have just shit the bed. So the last time they tried to taper was like 14, 15. I think they finished in maybe 15. Then they started raising rates in America. They raised them 15 to like 18. And then in 18, the stock market crashed 20%. And then they went back to doing the same as what they did. Provide liquidity and the whole thing starts again. So, yeah, I'd like to say that in 10 years' time we're back to 3 or 4%, but I just don't know how that. I don't know how that mathematically. I think mathematically there's no real way out of the current economic environment that we're in right now.
But isn't it just paying off debt? Isn't it just like buckling down and just paying it down and doing the hard yards? And because if we keep going negative,
austerity is what they call it. Austerity is not fun. Everybody wants money. Why would I want to pay down debt? That's boring. That doesn't win elections.
Doesn't win elections.
It's pretty obvious for the homeowner, and that's typically what like most homeowners do. They get this principal interest and they just aggressively pay it down, which we can see that in some of the charts for household credit. It's kind of just actually declined because a lot of people are taking out loans, but a lot of people are also paying off their loans. So it's pretty simple for them. But then we look at, probably going to get this wrong, but I think the Russell 3000 index, or 3,000 companies, 700 of them were categorized in the US as zombie companies. So the definition of that is they could only survive in a low rate environment. And they were like ExxonMobil, Delta, some of the four biggest airlines in America. There's a whole list of like, if you've got 700 companies that can only survive in low rate environments, then what's the fix for that? Because we know that they're not going to be allowed to go bankrupt, because the economic pain of that is far greater than just giving them more money or keeping rates a lot lower. So households, yes. Businesses, not so much. Governments, definitely, because governments can just pay the debt with more debt. That if they control the currency, then they can control the creation of the currency. Therefore, they can pay their debts to anyone.
Yeah.
But then that's where you've got to be careful with the value of your money just disappearing.
Correct.
It's like, this is the crazy thing about inflation. It's like, I like to think about it as like you've got a cup of orange juice and you just keep pouring water into it and you don't notice straight away. And you don't notice. You're just like, oh, okay, cool. That's fine. This is delicious orange juice. And then you keep tipping more QE, just tipping more and more. And you're just like, this is very watery. What am I?
Just drinking water by the end of it, Joe.
You're just drinking water. But then you just constantly have $1,000, right? You have $10,000 and then it can spend all of a sudden $9,000. So you're just constantly getting hit with this inflation. So and it seems to tend to hit. It's obviously again an easy statement to make, but it hits the lower middle income households the worst, because you need to eat, and if the cost of your grocery bill is going through the roof, you need to have power. If the cost of power is going through the roof, certain policies in America, of course, gas prices to go bananas. So you need to drive a damn car. Not everyone can afford a Tesla. What do you do there?
Good old Tesla. Yeah. So we'll if the audience has any more questions, throw those in, because I've got one more that's I think is an interesting one for an audience that was asked prior to the show. Was Chum, who asked, is there any credibility to the concept of an economic clock? So I'm not sure. I don't know if they're talking about the 18-year property cycle, or maybe it's economic clock is Dalio concept. If you believe that there is some credibility or validity to that, where do you kind of see that economic clock? Do you guys know what the economic clock is?
Yeah, I think they're kind of talking about this whole, this very similar to is it Todd something, the property clock, where it's got, it maps out every suburb or city around Australia and where they're at in the cycle.
Heron Todd White.
Heron, that's it. Yep. So
great little newsletter, but they did have Brisbane at the absolute bottom declining market last year. So, you don't believe everything you read in a newsletter.
Yeah.
It changes every 3 days, isn't it?
Let's have a quick look. Let's have a quick look at what that actually is. Okay. I actually don't know, so I'm just looking at it myself. So it seems like boom, interest rates, falling share prices, falling commodities. So higher interest rates, falling share prices, falling commodity prices, falling overseas reserves, tighter money, rising share prices, rising. This must mean falling interest rates. I can't actually see it, but I reckon that's falling interest rates, rising share prices, rising commodities, rising overseas, easier money. Yeah, I would say that's still relevant today. I would imagine. The only thing missing in there is obviously like manipulation of pricing through QE and the rest from government bodies, and the sort of the not really so free market that we think that we've been living under for the last 70 years, 100 years.
So I've just looked up the economic clock, and for those watching at home, and just I suppose it says it's either there's a boom, there's slowdown, there's recession or recovery. So and the slowdown's kind of from 12 to 3. Then you've got recession from 3 to 6. You've got recovery from 6 to 9, and then boom from 9 to 12. So I'm not going to hold you to any of this, but what do you sort of see? Where do you see we're at on those kind of boom, recovery, recession, or slowdown? Tough question, I know.
I think we're in both simultaneously. So it's
Jesus,
which is obviously not a clock. We're in a slowdown at the same time that we've got high inflation in certain aspects. We're in a boom in certain markets. We've obviously got boom in bonds, boom in real estate, boom in stocks. So if you look at the clock, you kind of can't really. I think that's a very big hands kind of thing. And if you plot it or if you charted that and said, well, this is historically how it works, and we can, again, like you mentioned, we can go back to sort of Ray Dalio's concept of the short and long term debt cycles here. But yeah, we're in a strange time.
Crypto goes from boom to recession.
Timely question.
Aaron.
Oh. Long-term debt cycle.
Printing lots of money, isn't it? Or creating lots of money rather than.
Yeah, that's. I think he seems to categorize the long-term debt cycle being that very much like you get down to zero, you can't really seem to normalize. You have to keep printing more money, and you kind of every QE that you do becomes less effective. Purely because you increase the base, or not the base unit, but there is some leakage into broad money.
Keep water in your orange juice.
Yeah. It's kind of interesting because after the printing money and credit comes revolutions and war. Gee, that sounds like some fun times. We're due for some revolutions and war, apparently.
Another good question. Oh, here we go. What are you saying, Tom?
No, I was just going to make a statement that it is interesting that the US aren't in a massive war at the moment. I think it's like maybe $1 trillion per year they spend on their military. So I'd be interested to see what happens with that, because I'm sure there's some issues with not having a war, and some of the companies that have for a long period of time benefited from such necessary evil.
Necessary industrial complex. They sponsor all these jobs. You haven't got a choice.
Were you about to bring this one up, Joe?
No, I was going to bring up actually the downward trend, but let's talk about this one. If
okay, sorry, yeah. So if the RBA was to raise the cash rates 3 times in 2022, what impact would this have on resi property? Interesting. This one's from Chris again. He's thanks for tuning in, Chris.
Do they raise rates? Like when they have done a raise, they do it in quite.
They do it quickly. Yep. So, the answer to that, I don't necessarily know what the outcome would be. I can only rely on like these other where we've got the trends here, where we've got interest rates, and let's go. I'm just going to compare.
My answer is it's going to make money more expensive, and it's going to make it harder for you to afford a mortgage, and a lot more people aren't going to be getting property. So if they do raise cash rates 3 times, I do see it being more expensive to hold property.
Of course,
and to cost more for your money. And property is the majority of property is debt. So if the debt goes up, then you should definitely it's definitely going to affect on prices. Like as we said at the beginning of this show, like having a $400,000 property at 3 point whatever I said, it makes a difference. So if the cost of money goes up, then the cost of housing and prices will have to go up with it.
Yeah, and it's probably also important to say, well, if it rose 3 times next year, that means that they would go, first of all, they're at 0.1, right? I'm pretty sure that 0.1%. So are they going to go up in 25 basis point increments? And if so, that let's say they did 25. I think we can just look at this other chart of what we looked at earlier, where rates did go up. What did property do? Well, it still went up. It still increased. It didn't have a drastic pullback. And rates went up between 2001 and 2007, like substantially. It went from sort of 5 to 8, 9, actually, sort of 9%. So
exactly. It's like how much and how much does it actually affect it?
Yeah. So I would, stop sharing.
I mean, I think if rates were to go up that, then there's a perception the economy is going gangbusters, really, because they would do that to try and cool down people sort of getting too much access to like the inflation going crazy. So I mean, I don't know, like it's an interesting one. I think 3 times in 2022 would be very ambitious. I'm not going to say it won't happen because but I just think once they'll fire a warning shot if they want to, maybe, or depending on how the economy, how the inflation kind of goes. They'll fire one warning shot, see what it does, and if things kind of freak out, then hey, that might be all we see. But
well, it's also market sentiment, right? Like if people are worried, like a 0.5% jump or a 0.25% jump in interest rates doesn't affect the market, but too much. But if people think it's going to affect the markets, that's going to affect their buying behavior and what they're actually going to be purchasing.
Exactly.
So it's also the perception of what that actually means. So this is why I think you're hearing the RBA being so, their narrative is like, oh, we're not going to raise rates until 2004. Don't worry about it. Don't worry about it. Don't worry about it. But I'm not so sure that that's going. I do think before 2023, well, maybe that's a bit ambitious, but I reckon, like there's going to be, I don't know, in my opinion, it's going to raise eventually. But
what would increase, what would cause wages to go to 3% though? If we open back our borders and have migration and continue suppressing real wage growth, if that's the catalyst for the RBA to raise rates, is inflation at 3% or between 2 and 3, and wage growth at 3%, or start with a 3. We need those two metrics to be met. Otherwise, you could raise funding costs of banks. So internationally, the banks would say, "Hey, man, we're getting tapped because we're now paying X amount % for." Well, that's an easy fix. The RBA just gives them more money for another 2 years. Maybe we do the term funding facility again and provide them with heaps of money at a lower rate to help out until such time that our economy gets back on track. There's so many things that they could do, and I don't think that I think they're stuck between a rock and a hard place, to be honest.
Yeah. On that note,
what does this mean? Like, what does it mean when we go into negative rates? Like, what actually happens? Do you have any kind of insights around like what it actually means from a, I don't know. You just think it goes, we're kind of at that zero. We're almost at zero. And then it's like, well, hang on. Once that goes less, do we get free money? Like, how does this stuff work?
Yeah, so there's an interesting letter or article on APRA's website about they basically put out in October, I think it was the 27th, 28th of October, they asked all ADIs in Australia to prepare for negative rates, and there was a lot of news about it at the time. And if you actually get down into the nitty gritty of the letter, it pretty much, the submissions they received back from the bank said, or from all the banks, are all confidential apart from like 3. I can't remember the lender that was on there, but they actually made their submission public. So I had a read of that, and they basically just said, we think deposit accounts under 10 million make up the vast amount of banking. So it would hurt the vast majority of our deposit holders if you implemented negative rates under 10 million. So that seemed to be the vast amount of submissions received. So they've said, hey, well, we want you to prepare for negative rates on accounts 10 million and above, effective the third of 2022. So March 2022. You've got to your systems must be ready for negative rates on 10 million and above. And you're right. What that means is I put 10 million in the bank, and I know that I'm going to lose money, but it's better than putting it elsewhere and having something else happen to it, let's say. So by doing so, you influence investor decisions, and you influence capital flows, because who the hell is going to put 20 million in the bank and lose money on it? Although it has happened and is happening in many parts of Europe. Yeah.
And you it doesn't mean that you can borrow money for free either, unfortunately.
No, Denmark I'm pretty certain it was Denmark that you could fix your rate at negative 0.8 or negative 0.7. But then the kicker was the fees. So yes, the bank is effectively paying you to take a loan, but then they're also increasing their yearly fees to combat. No one's going to make a loss, obviously.
Yeah. That doesn't the business model doesn't that business model doesn't work where you pay money to. Yeah, and if it does, let me know the person who's giving money up for free. And not
at 0.1% interest rate, we kind of already are negative, and that's why the RBA put a zero floor under the interest rate for reserves. So normally when banks hold reserves at the RBA, they get interest on it, and if we go to 0.1% interest rate, their effective rate is below zero. So to put a floor under rates, the Reserve Bank said, well, we're not going to charge you, you're not going to charge us, kind of thing. We'll leave it at zero, and that helped to keep a floor under rates. But because negative is an interesting thing.
Yeah, with inflation going rampant overseas, central banks such as NZ and BOE raising cash rate. Do you think that? I know, ignore the but there are some countries raising cash rates, like with New Zealand can you speak to anything about knowing anything about the New Zealand side of things?
No, I know they raised.
Exactly. Yeah, like
I'm pretty sure they raised it by 25 basis points, maybe. And then, but you can just look to like local economies can do kind of what they want. If you've got a booming housing market, and the best way to sort of stifle that growth is to just raise rates by 25 basis points, then by all means they'll probably will do it. But if it affects you, then you probably shouldn't be lending. You should probably be looking at what you can afford and what your repayments are, and what the realistic scenario is. If it does go up by 25 to 50, can you really afford it?
Yeah, I think that was an interesting one because of course New Zealand is a relatively or somewhat small economy, but they just they sort of raised it a bit against the tide of what was happening across the globe. But I suppose they probably felt they didn't have any other choice. I would say
to that the difference would be looking in the United States when they raised several times in 2017 to 18, and we did nothing. We actually cut rates. So you can have different economies do different things, and different factors influence rates. So yeah,
there you go.
Interesting. But I guess from what can we do as property investors today to bulletproof our portfolio? What are we doing? What are we going to do? How do we stop? How do we not worry? How do we sleep at night with all of this stuff? That's a question to you, Tommy.
Look, I would say just run the numbers, have confidence in what you're doing, have conviction, and factor in some of the worst. Like I hear when you had Steve on, he was talking through some of the buffers that he includes in some of his servicing when he looks at buying commercial real estate, puts it at maybe it was a 4 or 4.5, but he's factoring in buffers there and saying, does this still work out? Does this still make sense? And this probably doesn't. This probably isn't really relevant for owner occupied because they're just trying to get in at any rate. But for an investor, I definitely would say, just factor in a little bit of fat instead of looking at the rate that it is today.
Yeah, and have some half decent cash buffers, right? Like make sure that you're not going to be on the breadline with this next purchase, and maybe think about working a little bit harder on it. Maybe you need to do a value add. Maybe you need to do a renovation. Maybe there's something more to add to it rather than just buying the FOMO where you're buying an inner city apartment because that's all you can afford. So you've got to get in. You've still got to have the fundamentals backing up the purchase. But yeah, if you're having cash buffers, if you have some good returning properties, because otherwise your cash is just stuck in the bank account and you're not getting any money back from that. I have a friend that's like, it's the worst situation when you don't have a property because you can't offset your loan. So you're just getting savings account at 0.001, and then you're taxed on that income as well.
That's the beauty of it all. Yeah,
double-edged sword.
That's the beauty. So that's a sure loss. That's a guaranteed risk-free loss.
And then inflation eats it.
That's what I mean. You're negative. You already got negative rates with that, and it's a guaranteed loss. You're going to pull your money out in a few years' time and have less. And talking on inflation, like I said earlier, if you want to buy housing, well, your true cost of inflation is 20% at the moment. So if you've got if you're trying to buy the $1 million home with $100,000 deposit, well, you've now got $80,000 effectively, because if housing's has gone up 20%, your 20% deposit that you did need has just increased. So
yeah, it's an interesting way to look at it. Yeah, very true. Have you got any more comments and questions there, Jeff?
I'll be interested to see what happens with deposits in the future. Like if we keep having higher property prices, is 20% deposit a thing of the past? Because like everyone that
20% deposit for me. I don't know. There's people that are saving 20% deposits. I mean, I'm not saying I'm not saying people got to do whatever they feel comfortable with, but I'm as long as I got the cash buffers, as Joe's saying, I'm comfortable leveraging a little bit more. Not saying people should do that. People got to make their own decisions, yada yada. But 20% deposit. That's an interesting one, isn't it? There are still some friends and people I know who kind of in that mindset. They need to save 20%. I'm like, okay, you realize that by you saving that extra 50, 60, 70,000, it's going to take you 2 years. How long is it going to? How much? And then you save that, and then you need an extra. So I've had that kind of conversation a couple of times with people.
Yep.
Not saying it's wrong. I'm just saying there's consequences to leveraging more. There's more potential, more in actual risk, and there's consequences to saving more as well, potentially. And nobody has a crystal ball.
Yeah. That'd be a mind roadblock, wouldn't it? Like you say, I won't settle for anything unless I can put 20% deposit. But like you're saying, you then have to sort of take a backward step in your own head and go, well, if it's going up by 10% per year, well, what does that mean for my deposit? How long am I what am I saving? And if we just looked at the savings ratios, so people are saving 10% at $100,000, well, you're only saving $10,000 a year. So I would argue that the common investor is probably a little bit better than that.
Hopefully the Oz property investor is making sure they're considering their options and just kind of doing what they feel comfortable with, of course. But so before you sort of hand off, I did a bit of a meme session. So I have a bit of an announcement for Nick Montgomery. I'm going to contact him. I'm going to do a special meme. But the prize winner, what he's going to get is he's going to get the Polizzi package. So that's a funny way of putting it. I hope he's watching. I should tag him in, Joe. But it's going to be, he's going to get us. We're going to send a book along to Nick, and we've also got some other goodies as well. I've heckled Polizzi to give some one-on-one time. So he's very busy these days. Yeah,
he's doing a consultation, is he? So you've done a meme, and you said whoever comments the best comment wins something called the Policey package. And
I just made this up today. I was like, well, what am I going to call it? So Nick wins. So I'm going to do another meme that's just going to be super funny and super fun. And it's going to be more.
The amount of people that want Policey package is unreal. So thank you. You're lucky. Yeah. You're a lucky man.
Yeah, no, but I love this comment. He said something about what he wants for Christmas is he wants somebody to keep the kids, get the kids to sleep on time or something. So I was like, being the experienced parents, I mean, that's an inside joke. If you know, you know. But I couldn't resist. There were some great responses, but this is our last live session for 2021. So it's been great to have you along, Tom. But as we're wrapping up, what is a way? We have mentioned throughout this show that you are a broker. So if people want to reach out to you, what's the best way to people to get in touch with you?
So best way is just through the website, really. Website or Facebook. I'm always pretty active on either one of them. Hit us up, Summit Finance WA. We've got a website. Shoot us an email.
Do you service loans throughout all of Australia?
Yep.
Like if I'm purchasing in Queensland, like I want to buy in Queensland, can you help me out?
Yes, most of my clients are all East Coast based anyway. I've got a few WA, but if I actually looked at where most of my clients will come from, it'd be all Sydney, Melbourne, Queensland.
And where do you see people are starting to purchase? Like where are the actual locations looking like?
So WA here has been definitely inner city. No rural regional buys here. It's all been within that sort of golden ring of the Perth CBD and right up the coast. If you've got the best beaches in the nation, you might as well buy where you
it's a bit bitey, the old beaches up there though.
And then Victoria's been very regional, which seems to be the trend for like the last 12 months, really. Like I don't know, it's mainly from a COVID thing that everyone's just gone regional Victoria, or and then Queensland is just Brisbane. A lot in Brisbane. Some people were saying, well, I used to live in Sydney, used to live in Victoria. I'm over it, and I'm moved into Brisbane. Buying houses in like central sort of CBD of Brisbane.
Is this type of data available? Like I feel like there should be an index of the flow of people from a mortgage broking business to understand like the economics and movement, because the RBA, not the RBA, the ABS does some statistics and they release them every quarter or something like that to give you a bit of an understanding. But is there anything that you know of that has the inflow and outflow from a mortgage perspective? Because I'd be very interested to understand the supply from a massive mortgage broking business of where PPR people are going, because that's the true driver of, capital growth. They're willing to spend a little bit more. If not, we need to hit them up.
I don't. That's something that I'm going to have a look at now.
Actually. Probably like a privacy kind of thing. I mean, I suppose it's
no. You just anonymize the ABS does it.
Yeah.
They tell you what your religion is. They tell you how much you're earning. Like it's all anonymized.
ABS is the government though, Joe. So if the government's not going to find itself, though, is it? So I suppose my point is there's a risk that if you release that data or gave it out, that you have to protect it and kind of scrub it, and it's like, well, what's the benefit? I suppose for them compiling that data.
Well, the benefit would be 10,000 people going to Victoria, regional Victoria, instead of the city. Anyway, that's just
what's the benefit for the broking company? That's the I mean, I suppose they get a report. Actually, maybe we should do that. Maybe we should get
Get it, Tommy. Sure get this thing going. Let us know how it works, and we'll make it happen. But mate, I really appreciate you taking us through this. And this is one of the hardest things, right? When it comes to like understanding how this economic machine works. And you've covered off interest rates, you've covered off the RBA, you've covered off wage growth. So you've given us predictions even into 2022. But is there any kind of final thing that you wanted to cover off, or anything that you wish we asked you through the whole experience, the Oz Prop experience?
No, I'm pretty happy with what we covered.
Yeah, the audience.
We went deep.
Yeah,
it's one of those things that you could probably have to. Yeah, it's not a 1.5 hour thing. It's a good couple of hours and a few sit downs to constantly check where we're at. But
and where can people get educated on this kind of stuff? Actually, that's another question. Like, how do you wrap your head around? So first point of call, obviously, Ray Dalio's How the Economic Machine Works. It's 30 minutes. I think I've posted it in the group like 6 times. I named my business Property Principles because of the Principles book and the way that he talks about rules.
You spelled it wrong, though, didn't you? You spelled it the Aussie way. Doesn't he spell it the other way?
No. What? Principles? Right here. Principles like that. Great book.
He's actually got another one just coming out. What's it called?
Debt
just got it for
Cycle.
Christmas. That's it. Debt Cycle.
Big Debt Crisis or something.
Principles for dealing with changing world order. The new one's called Principles for Dealing with the Changing World Order: Why Nations Succeed and Fail. That's what the new one's called.
Yeah. Get through that over your Christmas period.
So get that, and yeah, watch the basics of economics from Ray Dalio. You'll thank yourself.
Awesome. Thanks, Tommy.
Before we do finish up, I just want to say I was probably this is our last 2021 session. We're going to be back in 2 weeks' time. I believe it's the 12th of January. So we're going to be back bigger than ever. 2022 is going to be epic. There's going to be so much value. But you guys, everybody out there have a safe, happy Christmas, New Year periods, and just enjoy some good times with friends, family, and don't do anything I would.
Have a great day, everyone. Have a great Christmas. See you later.
Yeah.
Let's go buy a property.
Thanks very much. Yeah.
Thanks so much.